Go ahead and jump into it. This is being recorded as well. So this is the first of our monthly Clear to Close webinars where I'm going to have industry experts kind of guide us in all these things. When when I started this, it was with the idea of every single month bringing in someone who is really, really good at their particular craft. And I couldn't wait to have Kalina on. She has been in the insurance industry since 2011. She's been working at her dad's agency that he started actually in 2001. Yeah, and she does awesome stuff. So I will let her kind of take over.
Hi guys, thank you for having me, Matt, on this webinar. I know the hot topic right now is very much of how, especially for realtors, is will my client be able to obtain insurance? How are things going to work out insurance-wise after the fires that we've had in LA? Um, and it's definitely a ever evolving world right now. It's not as cut and clear as it used to be. I'm sure we've all noticed that our clients' premiums are going up, um, losses are getting worse. Things just aren't as easy as they used to be. So, the main question that Matthew and I were talking about was what's going to be the path forward in obtaining insurance and helping your clients get insurance in the process of closing. Now, to start with the fires that we had in LA, I've had a few clients who unfortunately have lost their homes. It's been a really tough, it's been completely devastating for these people. And luckily, they did have insurance, so they're going through the claims process right now. And funny enough, my client who lived in the Palisades, her policy got non-renewed last year due to the risk of fire. And then I was able to help her get a fire insurance that was eventually secured. And lucky enough, she had paid her premium, so she was covered. With fire insurance and the way that we are seeing a lot of it happen is insurance companies are tending to pull back from these fire zones. If there's any risk that's even close to a fire, if there's a canyon, open space, any type of brush close to the home, they want out. They are completely risk averse when it comes to this. So what we're seeing is that a lot of times we're having to do a two policy split now going forward. We're having clients who are non-renewed for their insurance, and then we have clients who are purchasing a home and it tends to be in a somewhat what we considered a fire zone. Whether there's a huge risk of fire or not, we don't know, but according to the insurance companies, according to their modeling, we need to have a separate fire coverage. Now, with the way that you would obtain fire coverage, and I'm sure maybe you've guided some of your clients through it, is obtaining a California FAIR plan. Now we're having to do a two-part policy where you start with a fire insurance, which covers, for fire, wind, smoke, lightning, and then you have a wraparound policy, which will cover you for water and liability. Now, in the past, they didn't used to be like this. We only had one policy which would encompass everything. And if you're not in a fire zone, then you won't have that issue. If your clients have a condo, then you probably won't have this issue. This is mostly will affect single family homes where they will have to purchase a two policy insurance. And I know that uh, a lot of times we kind of get a little bit of a headwind, but Your client has to be able to work with a broker to obtain the fire insurance. They can't purchase it themselves. So you have to work with a trusted broker that knows how to work their system and how to be able to get you a quote and get you a policy so you can submit it to your loan officer and get the transaction to close. And I know if you have any questions about the California Fair Plan, I know that some people are worried about them running out of money, and there's been a lot of talk about that, especially since the wildfires that we had in LA. So essentially, the California Fair Plan is a pool of all the insurance companies in California. So they have a certain amount of cash reserves, they have reinsurance, and if the losses that they're experiencing go beyond the reinsurance that they've got, which at the moment I believe is 2.5 billion, they are going to assess the insurance companies in California the remaining amount, which will then be paid by the insurance companies. So when you have a client who's worried about, well, even if I get fire insurance, am I really going to have coverage? Am I really going to get covered if my house burns down? What if they run out of money? Now, insurance companies most likely will not run out of money. They have billions and billions of dollars, but if I guess worst comes to worst, according to the laws that were recently put in 2024, they are planning on, if they are not able to provide the funds for the California Fair Plan assessment. So let's say the way that it's broken down is by the amount of policies that each company has in California. To give you an example, if State Farm has 25%, then they will get assessed 25% of that amount. Farmers has 15%, etc., and it goes down the line. So we have to, keep in mind that the fair plan should be they're supposed to be the insurer of last resort. So we as agents have to do some due diligence and make sure to search for a policy. And if that policy is not available, then we turn to the California Fair Plan. You want to go to the next slide?
Absolutely.
All right. Yeah, okay, so we hit that with the safe. Yes, it is essentially it's going to be a two-part policy. And the liability in water is not covered through the California Fair Plan. So if you have just fire, I don't think it's sufficient, and I don't typically advise my clients to just purchase fire insurance.
Good deal. Kalina, could you real quickly, just your client, unfortunately, that did lose their home in Palisades, kind of what does the path look like for them moving forward?
So she's very hopeful that she is going to rebuild her home. In the meantime, she is working through her policy, the claim. She has a good amount of money. Luckily, she was well covered. She did have replacement cost coverage on her policy, meaning that when you have some of your clients purchase their policies, some of them will be actual cash value and some will be replacement cost. Now, replacement cost is that they will try to replace one for the other, the one that was essentially lost. So you're looking, which will not include the depreciation. And this means that the client will get almost, if not all, the money. If it's actual cash value, you're running the risk of receiving the depreciated amount. To give you an example, if you have a roof, the roof is 20 years old, they're going to take the value of a roof, let's say $30,000, they'll take the depreciation out and you are going to receive the actual cash value for it, which means a lesser amount to replace the home.
Got it. So there's two different policies, and then for this woman, she had the replacement cost policy, right? So she will get the home replaced, correct?
Yes, up to the amount of her coverage minus the deductible, of course. She does have some additional coverages for her personal belongings. That's on top of the building. She has additional living expenses, which is also being paid out for the time that she has to rent another place until she is able to rebuild.
Okay. Awesome.
Yeah. It's just going through the process. That's all it is. So there's some companies who are great and some who are not so great when it comes to these claims. I have had if you have clients which have what we call surplus policies, these are companies that issue a homeowner's policy that is not, the company is not licensed by the California Department of Insurance, meaning that a lot of times they don't have to abide by the rules. They're not financially checked. And if something does happen, something big like this, you don't have the backup of the California Department of Insurance when it comes to that. So it's definitely a little bit of a risk, but it's just dependent on what the client is comfortable with. But my two clients, one who had a California Fair Plan policy, that was with a standard admitted company. She's almost getting she's getting service almost right away, versus the one which is with a surplus company, she's getting a little bit of more pushback. They're trying to get receipts for X, Y, and Z, these types of headaches, which is not something that someone wants to deal with, especially after total loss. I have seen companies that are just printing checks at the sites, and that's a really nice sight to see. Knowing that they are trusting their insureds, that they are not haggling them and hassling them at a time when they need it the most.
For sure. For sure. Can we move on?
Yeah. All right. So, one thing that I wanted to share on this slide is how California premiums for homeowners insurance uh, is being matched up to the rest of the states. As you know, we have had some of the most destructive wildfires in history here in California. It's costing billions upon billions of dollars. And the homeowners insurance prices are not reflective of that. And mostly that's due to bureaucratic and regulatory issues that we've had. For example, insurance companies can't raise their rates more than a certain percentage. Beyond a certain percent, which is 6.9%, they need to go through a very deep regulatory approval. And because it's so difficult, insurance companies can't catch up to the rates they're supposed to be charging. So instead of them trying to catch up and doubling or tripling the rates where they're supposed to be, a lot of companies have decided to leave the state. For example, State Farm was the biggest one. Allstate many years ago did this. I think they haven't been issuing policies for about 6 years now, homeowners policies. So State Farm was definitely the biggest one, and essentially they just can't raise their rates fast enough to be able to withstand the losses that they're seeing in the state. So they've decided to pull out. And so this is happening a lot to many companies.
Got it.
You know that wildfires, of course, are driving up the premiums. We have very few insurance companies which are taking on these losses. Now, I don't know if things will change in 2025, where we are hoping that more companies come back into play. That will make the marketplace a little more competitive. But the question that I've been getting recently is, will my premiums go down? And I can tell you, no, they won't. I don't see insurance premiums decreasing, especially at a time where we're seeing such big change happening. As you can see, some of the big states where we see a lot of, climate change, events that cause insurance losses are, Florida, number one, of course, hurricanes. We see them in the South, Louisiana, we see them in Texas, and the premiums for insurance are not nearly as close as we are to some other states where they're supposed to be higher.
Yeah, that makes sense.
All right. And does anyone have any questions? These are some of the questions that we prepared for your clients that they can turn to their agent. Reach out to your agent, and ask your clients to ask their agents some of these questions. Are they covered for fire? Is there sufficient coverage for the home? That's also another big one. A lot of people won't have, my recommendation is always, at the moment, it's at least 300 to 350 a square foot, especially here in San Diego. We're running to even higher per square footage. I know Los Angeles is going to experience a very high per square foot amount in the upcoming years, but on average in California, we're looking at a minimum of 300. And then something that you want to check on the policy is check whether it's replacement cost or actual cash value. Sometimes companies will offer their policyholders a very, very high dwelling amount, but then they'll put ACV next to it, which means that you are not paying for the coverage that you think you're getting. Or you're paying for the coverage, but you're not going to get it. So if someone, let's say they have $1 million policy, it's ACV. If there's a total loss, you're probably not going to get that $1 million in coverage. Another big mistake that we're seeing recently is that people will purchase a policy with the wrong occupancy. Um, it's a little bit of a headache for the insurance company. They are improperly being rated. So make sure that the occupancy is correct. If a client is buying an investment property, they need to purchase an investment property insurance or a landlord policy. The final one is to make sure that they have additional living expenses. That is the coverage that will pay if there's a total loss for them to go into a hotel or to have temporary living expenses covered. So Airbnb, their rental, wherever it is, has to be covered through their policy.
Awesome. I think Margarita had a question real quick.
Hi, Kalina. Hi, Matthew.
Hi.
I do have a question. I know some homeowners put their homes in a trust.
Mhm.
Does You might have answered this question before I was late, sorry. Does that affect on insurance? Should we let the insurance know, or should our clients let the insurance know if they have the home under a trust? Would they be any issues with coverage since the name doesn't match?
So this was something that popped up on a TikTok video right
Mhm.
after the LA fires. I've had this question before because it went from TikTok to Nextdoor to Facebook. So most of the time, we do want the name of the trust added. Now, if you got a policy and then you happen to put the property in a trust, but you are the beneficiary of the trust, there is not going to be, I would very, very much doubt it that the insurance company is going to decline coverage based on that. Again, we're not seeing this happening, but I don't want to speak for anyone because
Yeah.
their policy might be different than what I'm seeing, but I've never had an issue where someone didn't get paid on a claim because they didn't list a trust
Okay.
on a policy.
It was sent to me by a home warranty rep. So I was like, hey, it just sparked up in my brain. I didn't see it on TikTok. I don't have TikTok. I didn't see it on
Yeah.
social media, but I did nonetheless get it sent to me. So I was like, I'm gonna ask
Yeah.
that question.
Yeah, I've had several people call and ask me that, and then I figured out I was talking to other agents, and they said, "Yeah, it's a TikTok trend. We've had some like 5 people ask us today." So,
No, I don't have one, but thank you for answering the question. So it would be pretty much calling to if a client were to ask me, tell them to call their insurance provider and ask
yeah,
them
you
direct.
can add the trust. It's not a big deal. Add the trust as an additional insured. Have it listed there, but uh, don't lose any sleep over it. It's not something that is going to jeopardize their coverage.
Awesome. Thank you.
Mhm.
Awesome, Kalina. I think we can move on. Yeah.
Sure.
So this is the portion we kind of want to open it up. We have a smaller group here tonight, and there are probably some questions. If it's anything that Kalina has covered thus far, or just something that hasn't even been addressed, you guys can come off mute. You can ask whatever you would like at this point.
Well, I had the same, hi, Kalina, Matt,
Hi.
everyone. Thank you. This is Tanya Parks. Um, I had the same question about the trust thing, right? As a real estate broker, yeah, the rumor's been going around. So I'm so appreciative that you could kind of clear that up. And it sounds like the best advice is just to tell people to call their rep no matter what.
Yeah.
And then I just have kind of a bigger lens question. We know, and thank you for clearing up how the funding works in terms of all the insurance companies sort of being having to continue to pool funds to make ultimate coverages.
Mhm.
But I just it's just a big lens question, and if it's not for this discussion, that's fine. But as the landscape of insurance changes, I'm hearing about sort of small private insurance kind of built through crowdfunding and no brick and mortar and using AI actuaries, and some people feeling like that's kind of the hope for the future if you're in areas that can't get good insurance or supplemental or have too many companies leaving the state, leaving that area. So I'm just curious if you've heard anything about that. And then I'm also curious, could you flesh out a little bit more? It would seem that you don't need to have the split policy if you're in a condo. I'm assuming that's because the condominium itself, they have their own insurance. But sort of how do we know if they've elected these blanket coverages and specific coverages to fire? Thank you.
Yeah, of course. I haven't heard regarding part one of your question. I haven't heard of people starting their own insurance companies. I would imagine that this would take significant funding on their part, kind of crowdfunding insurance. Keep in mind that they have to have uh, billions of dollars in reserves in order to be able to be prepared to cover big losses like what we're seeing in LA. For the most part, essentially what people don't tell you is that the California Fair Plan does not deny coverage to anybody. So they are almost guaranteed to issue fire coverage. They can't deny coverage. But it's a matter of how much is it going to cost. There's some people, if you're living in the middle of the wilderness, no fire hydrant nearby and no fire department nearby, it's probably going to be more expensive. If you are in the middle of a city, it's probably going to be much cheaper. Um, and your second question about the condominiums. So, as you probably know, if you have a client who has a condominium, it's very similar to having, right, they're covering the inside, which is called an HO6 policy, and that covers the interior of the condo. And then you have the master policy, which is the entire association that has a policy together. And so your monthly HOA fees go towards the master policy, but your HO6 policy will cover you in case of damages inside of your unit. Now, the master policy, it has to be covered. It has to cover fire. That's most likely going to be in the CCNRs. A lot of condominium associations have had hard time with obtaining coverage, but they are required to carry fire insurance. Did that answer your question?
It really did. And thank you so much. And thank you for defining the actual name of coverage plan for the individual owner, the HO6. Thank you.
Yeah, exactly. In regards to the crowdfunding, I haven't heard that before, but that would be interesting if we start seeing that. One thing is maybe we have to be careful because will that type of policy be accepted by a lender? So maybe Matthew can contribute to that one if that's something, or if it's called, I don't know, a self-insurance, something like that. But I would only imagine that a cash buyer would be able to be okay with something like that. And a bank typically would want a A-rated company that covers on replacement costs. That's what we're seeing a lot of right now. With the way that underwriters are tending, especially at a time like this, they tend to be combing through policies. They're very, very picky when it comes to the coverage. So they want coverage for replacement costs. In the past, they didn't care. They would just take anything. They would just need fire to be covered. Now they want that two-part policy. They want to see that it's replacement cost. They want to make sure that it's paid more often. We are seeing letters if someone lapses on their homeowner's insurance, immediately they're getting a letter from their lender saying that we can't verify your coverage. We're about to force place insurance on you. And you might have ran into that with some of your clients if they forgot to make their payment or whatever happened in their instance, but they are very much following up on making sure that the property that the bank still owns is covered by insurance.
Since it would seem that people doing the ACV route,
Mhm.
are insurance representatives just across the board suggesting the replacement cost plan? Why would some people be choosing the ACV? And is it just, are they not being educated? Is it just kind of a rush job?
I think it's multiple things, but the number one is usually cost. Those policies tend to be cheaper. So we're finding that a lot of times people are aiming to get the cheapest possible insurance, and kind of hoping that nothing ever happens, you know? So if nothing ever happens, then they'll never have to deal with it. But if something does happen, that's when you start looking at what you're really covered for. Um, and unfortunately, I think a lot of people have come to the realization that your coverage matters, especially if you live in a fire-prone area.
It's a good point, Kalina. And Tanya, as a lender, I know that most investors are not going to accept actual cash value policy. They're going to want a replacement because they are basically the ones they are insuring. Because if it's something is to happen, the mortgage needs to be covered.
Well, that makes perfect sense. Yeah, absolutely. You bought the $2 million house and it's got the 40-year-old roof that's only worth $8,000. You guys don't want to make up the difference. Yeah, I get it.
Mhm. One thing that I forgot to mention earlier is if a client, and this we have seen this actually with it came up more often because of the fires that happened in LA, is if a client lapses on their policy and the mortgage force places insurance on them, the beneficiary of that insurance that is force placed by the mortgage is going to be the mortgage company. It's not the client.
Oh wow. So like the mortgage company is the one that's making the call to the insurance company, not the owner.
Right. So they will collect their money, but I don't know how, in the case of a total loss, uh, none of that money that's on this forced place policy is going to go to the policy holder. Or, I mean, I'm sorry, not the policy holder, but the client. It will go to the mortgage company. So,
That's interesting. It's interesting that you mentioned that because I had an issue at my house, my home, and we're up to date with our mortgage payment and everything, but we still had to go through the mortgage company. to get any of those funds. So the check, if it exceeded like $30,000, had to be sent to the mortgage company, and they would release it upon inspection to make sure that the home is being repaired, because it's a risk for them, obviously. But even if you don't um stay on track with your insurance and it goes down that route that you're saying, you
Mhm.
still have to go through the mortgage company to get your funds. At least in our case with State Farm, that's what happened.
Yes, yes. Have you guys had clients who did suffer a loss from the fires recently?
Thank God, no.
No,
Okay.
thank goodness. San Diego has been spared many times. We've had a couple in my time here, about 15 years, but it's just inevitable. It's just inevitable. So,
Yeah.
it's so good to hear from you. And I already know from the conversations that I've been having with clients who are very sophisticated people, very savvy people, have phenomenal real estate investments, and they're just kind of clueless about what their policy entails and provides. They just
Yeah.
sort of signed off when they bought the house, and it's sort of out of sight, out of mind. So,
Exactly. Exactly. And it's this is definitely a time where we're seeing a lot of people come back to their agent and really comb through their policy. I have gotten more appointments to review their policy than probably in the last 15 years. People are definitely interested. They're raising their coverage. The number one question is, am I covered for fire? Even if they're not in a fire zone, they'll say, am I covered for fire? And then, of course, we have to review and see. But most of the time, like you said, if it's out of sight, it's out of mind, it's being paid, that's that, and you're just hoping that nothing happens. But it's also important that your clients pick reputable companies. If you are going to buy insurance from a company that's ran out of someone's garage, don't expect good customer service when things hit the fan. So we're very much in the industry of you get what you pay for. So this is 100% the case at the moment.
Awesome, Kalina. Yeah, and I know Kalina's office is in Oceanside. Actually, it's right across from the very first office I worked at off El Camino. She's well versed. I'm gonna put her contact information up here. If no one else has questions, you can get a hold of her.
yeah,
If she,
I'm sorry to interrupt you, Matt. Thank you so much. And are you writing policies for San Diego?
Oh yeah,
Okay.
yeah. We are open for business.
All right. Pardon, Matt.
no, you're totally good. Yeah, I mean, I've been working with Kalina for since 2017, and while I don't always like her answers, they are very straight and honest answers. And I joked with her before you all jumped on. She's the most popular girl in town right now. So
Oh, I know.
Yeah, yeah. Well, luckily we've still been able to write policies for all over California, and you guys might have some clients which are in LA and all over the state, and it's a big question right now about what's going to happen with the landscape of insurance, but it's something for you guys to also prepare your homeowners and your buyers. Will I be able to afford the insurance on this house that I'm purchasing? And uh, for something for them to know is, your insurance might cost $3,000 this year, but it will probably be more next year. Uh, and so it's something that they should be prepared to continue on as they become a homeowner.
Yeah, and hearing you say that, I've changed my approach really even in the last 2 years. And I tell people it's as important for you to get pre-qualified with an insurance
Mhm.
representative, as it is with a lender. I want you to give them a call at the same time. And I
Mhm.
just want you to create a relationship. And I'm really excited to send some people to you because my top guy was an all-state guy and he did leave the state. They did close up in the state. Um, but just knowing up front, people need to know up front what they can expect. It's kind of the last thing they're thinking about when they're buying a house.
Exactly. And it used to be, and that's totally normal because it used to be the last thing. Insurance was very much here's the policy, here's the price, do you want it? And it's no longer that. We can't wait until 5 days before closing to get a policy. It's
Exactly.
very much when your client goes into escrow, they should reach out to their agent, whoever they are, and get a policy, or not a policy, but at least get a quote. Know how much your policy is going to be.
Yeah.
So they are not, if they've waived all contingency and then it turns out that they can't afford the insurance, then they get mad, right? And they get frustrated in the
Oh,
buying.
100%. Yeah.
And we as the professionals are going to get, that kind of blowback from the client that, oh, I wish I would have known that this was the cost for XYZ, and that would have prepared them for their upcoming purchase. And it's a big step. It's a big purchase, so they need to be prepared. The same as they'll probably need to know how much their property taxes are going to be. Are they going to be able to afford that? And it's the property taxes, insurance, and overall just being a homeowner is costly, and it's becoming more and more costly these days. So
Right.
it's
Well,
not
it's
it's
just
not
not
as
that afterthought anymore. It is like in the
exactly.
past, I'm guilty of, you know, 7 days before escrow closes, call an insurance person. No, now we're doing it day one. At the same time, we're calling the lender. And it's now becoming a critical deciding factor
Mhm.
and also a critical term on contracts. So, I might have clients that fall in love with two different houses. They kind of like one more than the other, but then they find out that the insurance on that's going to be $10,000 a year. And it's like, that's not going to work for them. So suddenly the other home looks a little better. And then writing it into contracts in order to really win with the term that we will we will get qualified for insurance and within the first 10 days, right? Within an inspection period, right? So that, you know, people know up front. And I'm looking for that when I'm on the listing side. I'm looking for someone who's coming with an offer that's addressing assurance up front. It's as critical as anything now. It's not an afterthought. It's so good
Yeah.
to hear you talk about it.
Yeah. Yeah. And I appreciate you guys coming on this and uh, you know, learning more about it. I know most of the time we kind of are in our own separate boxes. You do the loan, you do the insurance, you do that, right? But now that we're all working together, we're all trying to figure it out step by step. And I think it's helping when there's more communication that makes life easier for you as a realtor, for the buyer and everyone around when everyone's kind of on the same in the same loop.
For sure, clinic. Yeah, definitely more of a team approach. And I definitely, with all my borrowers, I'm like, hey, these are insurance is something we need to start thinking about. I know I've reached out to you and asked if certain addresses are in fire zones because the maps aren't as easy as they used to be, or you've been pretty awesome with kind of helping me navigate that. So, when someone sees an insurance policy at $300 a month, it's not shocked because, that guy down the street told me it was $100 a month or whatever they thought it might be, right? Like let's figure out what it really is instead of what it might be, right?
Right, right, exactly. I mean, and one thing for you too, as a realtor, when you're looking at a house and if I have this beautiful view out the backyard to an open canyon, guess what that means? Most likely they'll need a separate fire insurance. That also probably means they'll probably pay thousands of dollars more in insurance because of it. So it's something for them to be prepared with when you see that kind of property, is assess the risk. Now, not everyone comes uh, to look at a property with that kind of mindset. You know, maybe because I've been in insurance for so long that wherever I go, I'm thinking, oh, well, there's no fire sprinklers, there's no fire, all this kind of stuff. It's ruined me forever. But as a realtor, when you're showing a house to someone, just take a look at the environment and what it's like. If you have clients who are out in lakeside area, who are out in more wooded, if they're not in the city, in the middle of a city, if they have canyons, brush, any kind of I would call it a fire zone or high risk fire, then it's something to address with your clients even before you go into the escrow process. Now, I know that you can't run a quote for every home that you show, because that takes a lot of effort and it's a waste on a lot of people's time, but it's something to be aware of. Right now, we saw that, yeah, the average premium used to be $1,500 in California, but more and more, and what I'm seeing now, just two policies that were issued, that I had issued today, it was in the $5,000 range. And it's only because two of them were in Poway, and Poway, of course, we just had a fire there last week. So that shouldn't surprise people that there's a fire policy needed. Now, you're doing a fire policy and you have the wraparound, and it adds up. So we're looking at close to $4,000 is the range that we're getting for some of these high fire prone areas. Now, if you're more in the city, less of a risk of fire, you can pretty much find a straightforward policy which will have a premium, I would imagine, in the $2,500 to $3,000 range.
Awesome, Kalina. That's super helpful. While it's maybe not what everyone wants to hear, it's what everyone needs to hear right now, and that's the reality, right? I don't know if I recommended you, but like the book that I've been reading, Full Fee Agent, it just talks about that, like just being fully transparent. And that's, one of the many things I appreciate about you.
Mhm. Thank you, everyone.
Yeah, so we will send a recording of this out. I'll send a little pamphlet. Kalina's kind of been kind enough to give us a lot of information, questions that our clients can be asking and whatnot. So I definitely appreciate all of you on the call. I appreciate your professionalism, and I appreciate being on your teams at one point or another during my career.
So much value tonight. So deeply appreciated. And I'm so glad you're in Oceanside. And I'm so glad you're writing policies. I'll send an email and set up a time where maybe we could just have a quick introductory call. And so grateful. Thank you, everyone, for
Fantastic.
putting this
Thank you.
together.
Thank you, everyone.
Absolutely. Thank you, ladies. Have a great evening.
Thank you.
Thank you,
Take care.
everyone. Appreciate it.
Bye-bye.
Bye.